Good morning. My name is Kevin Lyon, and I'm the Chairman of NextEnergy Solar Fund. I'd like to welcome you to our full year's presentation for the period ended 31 March 2021. I'm joined in the call this morning by our investment manager, NextEnergy Capital's Bonte-Friedheim, Group Chief Exec, and Ross Grier, UK Managing Director. 2020 was a year like no other. The uncertainty and restrictions caused by the global pandemic impacted every corner of the globe, with economic activity undoubtedly suffering. We saw UK power prices unexpectedly fall, although they have now recovered, and this has affected all renewable asset owners in the UK. The board and I are pleased to announce that against this backdrop, NESF has announced today a solid set of financial results, which continue to deliver strong operational performance. This demonstrates the robustness and the value add from our investment manager, who continues to actively manage and add value to the portfolio, for example, effectively managing our power price risk. Now more than ever, there's a need to act to tackle climate change, and a seismic shift towards renewable energy supply is key. Solar is now the lowest risk and cheapest form of renewable energy available globally, and NESF is well positioned in terms of its current portfolio and growth potential to capture this opportunity. We are a specialist solar power renewable energy investment company. We currently have 94 operating solar assets in the portfolio, with an installed capacity of 814 megawatts, which is enough to power 195,000 homes per year. Our dividend remains covered at 1.1 times. We continue to achieve our dividend targets year on year, and we currently offer one of the highest dividend yields in the sector. Our consistent operational outperformance allows us to return an attractive income to investors. We believe we are primed for growth. We continue to contribute significantly in tackling climate change, and through our solar assets, we are helping the world transition to a cleaner energy supply. I'll now hand over to Mike to run us through the presentation.
Thanks, Kevin. Going on to page 6, before continuing with more details around NESF, I wanted to give you an update on NextEnergy Capital, NESF's investment manager. NEC is a specialist solar investment and asset manager with nearly 200 members. We are exclusively dedicated to solar out of the conviction that to generate alpha for our investors requires an expertise, dedication, and focus that only specialization can deliver. And over 7 years of NESF's performance demonstrates this. We are active as an investment manager, an asset developer, and an operating asset manager. And the combination of these three activities benefits our investment vehicles, of which NESF is the flagship. We have a unique understanding of solar, gained from acquiring over 240 solar assets, developing over 100 projects, and managing in excess of 1,000 solar plants over our 15 years in the sector. NESF benefits directly from this extensive and unique experience and expertise in the solar sector. Now back to NESF. On slide 7, selected highlights for the past year include group revenues, unaudited, of over 100 million, with an EBITDA of nearly 80 million. The 7th year of generation outperformance versus budget of 5.2% in this year. Selective value accretive growth via 4 new assets in their portfolio, totaling some 115 megawatts of additional capacity. Risk mitigation, generating some 7 million in higher revenues from our electricity sales desk hedging strategy, and steadily increasing positive ESG contributions across the entire scope of the firm. Given the strength of our financial and operational performance and the prospects looking forward, the board has approved a dividend target for the current year of 7.16p per share, up from 7.05p per share, an increase in line with RPI. Of the 4 assets added to the portfolio, 2 were new build assets backed by 15-year PPAs with AB InBev, the world's largest brewer, covering some 75% of electricity generated. This PPA with a high-quality offtaker effectively has reduced our exposure to short-term UK power prices for over 10% of our installed capacity. As indicated earlier, this was our 7th year of outperformance, demonstrating resilience and sustainability in performance regardless of the operating environment. This track record is unique in the sector. Now, over to Ross for a forward-looking strategy update on our growth plans and outlook.
Thanks, Mike. Over recent months, we've not only been active in adding incremental capacity to the portfolio, but we've also been preparing the final assets for construction to achieve the 150 megawatt target of subsidy-free assets that NESF has. But we also acquired two 50 megawatt sites carrying an industry-leading corporate power purchase agreement with AB InBev, the world's largest brewer. We've also been preparing for NESF's next wave of growth, including amending the fund's mandate through the AGM to enable 10% of GAV into energy storage solutions, 15 and 30% of GAV into private equity structures and international solar assets, respectively. Where we've seen pricing for subsidised solar in domestic markets reaching what we think are unsustainably high levels, we do see attractive international solar assets in OECD jurisdictions. These add both geographic and energy market diversification to the fund. NEC has strong experience in investing in OECD countries and in bringing forward hedging strategies to mitigate any FX risks that its funds take. Additionally, we've been closely monitoring the battery storage market in the UK for many years. NESF was an early mover, acquiring several small utility-scale batteries in 2017. Running these has allowed us to deep dive the components of the business case as the market has evolved. We've seen this space maturing significantly over recent years and see the current market as an attractive opportunity for NESF. As renewable energy penetration continues to increase, so does the volatility of the energy on the grid. Batteries make their money from this volatility and are very complementary with NESF's existing portfolio. Utilising NEC's track record in the private equity-backed renewables space, we've identified interesting opportunities for NESF to invest in this space. This avenue of investment adds indirect diversification and co-investment opportunities in an environment that can offer superior returns and incremental revenue generating potential for the fund. The in-house team of solar experts in the NEC group continue to focus on the long-term performance of the portfolio. Alongside this, the energy sales desk continues to roll forward hedges as the market presents attractive opportunities to forward hedge power. So to summarise, the strategic focus is to increase portfolio diversification, target a dividend of 7.16 pence for 31st of March 22, strengthen the dividend cover going forward, maximise income generation from the portfolio over the long term, and to increase NESF's net asset value.
Let me highlight on this page, NAV per share largely unchanged over the year. Total gearing of 43%, with preference shares adding a low cash cost and protective element to our balance sheet, and an annualized total shareholder return of 6.1% since our IPO in 2014. In terms of revenue generation, in 2020-21 versus budget, we recorded significantly higher revenues, 6.6%, lower OPEX of 6.2%, and as a result, a notably higher EBITDA in excess of 10.5% above budget. On a net cash basis, this year again, we achieved a positive dividend cover of 1.1 times. In terms of the valuation parameters of the portfolio, you will have seen this information from our press release in mid-May, and so I will skip forward, but happy to take any questions during the Q&A session. Let me highlight again the strength of our balance sheet. The preference shares are particularly attractive as they have lower cash costs versus project finance debt alternatives, and also have a multi-year option for NESF to redeem those shares at nominal value starting in 2030. We have been increasing the transparency of the information we provide to stakeholders, and this page is a further step in that direction. The information presented here should enable a more detailed financial analysis by market observers and the realization of the lower cost structure and resilience of our balance sheet, combining both project finance debt and the preference share issue that I mentioned earlier. A large portfolio like ours, with 94 individual assets, provides investors with single asset risk mitigation and diversification by location, technical components, and operating partners. NESF leverages NEX's electricity sales desk and capabilities to hedge forward price exposure and eliminate spot market risk from the portfolio. This is often misunderstood by many stakeholders we interact with. As a result of this electricity sales strategy, NESF does not sell power into the spot market. Looking back on the past financial year, our electricity sales strategy has consistently secured prices for NESF well above the forecasts provided by our market consultants. As I will show you later, power prices have increased very significantly in the UK to levels well above pre-COVID prices. As you can see in the bar chart on the right, we are continuously active in the market, reacting to opportunities or the changing environment to lock in attractive prices for the portfolio. As you can see, the average of the 3 market consultants we use for our forward curve has declined beginning 2023 compared to the year earlier forecasts. Interestingly, this contrasts dramatically with what the forward prices in the market are evolving towards. The market price of power for the next 3 to 4 years has increased dramatically during the 2021 calendar year. If you compare this to the market consultants' forecasts on the previous page of some £45 per megawatt hour, you can see the disconnect where, as an example, summer 2022 is currently trading at about £60 per megawatt hour. If these higher power prices persist, you should expect NESF to secure significantly higher revenues over the coming years.
Moving on to ESG, we continue to work with the Green Investment Group to independently verify our positive ESG impact. This financial year, we've powered more than 195,000 homes with clean, green energy. We also achieved compliance with the EU Sustainable Finance Disclosure Regulation, ensuring we're providing consistent and rich data around NESF's ESG profile. We've continued to enhance biodiversity measures on our sites and have demonstrable results from our exemplar assets, including 500% increase in key populations of bumblebees, 300% increase in other pollinators. And given the catastrophic global decline in biodiversity, these results are outstanding and demonstrate the potential additional benefit solar PV can have for the communities in which we operate. NESF has continued to support incredible projects throughout the world via the NextEnergy Foundation. Founded in 2016, the Foundation's mission is to alleviate poverty through the nexus with clean energy access and emissions reduction. And now passing back to Mike to run through the summary.
Thanks, Ross. NESF, looking forward, is very well positioned for growth along the various strands of our investment strategy. That growth strategy is based off of a very large portfolio of operating assets. Our dividend for this year has increased and should be considered as highly attractive in the current market. We continue to be focused on delivering attractive shareholder returns and NAV optimization. This comes also through our continuous and unrelenting focus on asset management and portfolio outperformance. We have the starting position of a very efficient and low cost and resilient balance sheet financing structure. And we use all of our skills throughout the organization, in particular those of our electricity sales desk, to optimize the revenues of NESF looking forward into the current year, but also the next coming years beyond this financial year. And that concludes today's presentation. Thank you all for your attention. We'll now open the floor for any questions.
And we have a question from Marcus Jaff from Peel Hunt. How do standalone storage assets fit with being a specialist investor in solar?
We have an extremely robust investment process in NextEnergy that challenges all components of every business case for each type of asset that comes through the door. This looks at both technology and also partners and the contractual structures that sit behind the various different revenue components of that business case. And therefore, anything that comes into the fund is extremely robustly challenged on the way in and throughout its operational life. Our operational experience from the current batteries that we own within the portfolio also has allowed us, as we've said earlier in the presentation, to deep dive the business case and really understand how the various components of the revenue stack for a battery have evolved over time. We also have the in-house energy sales desk, and really that allows us a unique exposure to exactly what's going on in the power market at all times, and also therefore how both the solar side of the portfolio and also the batteries can be monetized in the best way. We therefore feel really well placed to increase NESF's investment into battery storage at this time.
And we'll go to Adam Forsyth from Longspur. Adam, do you want to go ahead and ask your question?
Almost just to follow up on that response around batteries. Given that your UK PV portfolio effectively gives you essentially a long position in the UK market, are you likely to have a different battery strategy from the battery-only funds out there? Specifically, they seem to be targeting at the moment, the dynamic containment market in the revenue stack, and perhaps less so in trading. Are you likely to have a more trading-focused strategy going into the market?
And we will have a similar strategy to those other entities that are out there. Certainly, there will be a trading component of it, but we also expect to benefit from those products that allow us to interact with the stability of the grid as well.
Okay. So you'll almost run them as almost standalone rather than as part of a wider portfolio with the PV assets.
If I can add to the point that Ross just made, certainly it is so that we believe that combining storage resources, be they batteries or new technologies in the future, has a strong strategic and financial rationale in the combination with solar generation assets. And that is why 4 years ago, we started investing in this space, because as a solar specialist, anything that relates to solar more broadly, be it new add-ons that we can build into existing sites, be it ancillary technologies like storage, will always be at the forefront of our innovation and our team's focus on innovation. And so, yes, currently in the market, as Ross said, our strategies will be similar, but we have, given the long position that you mentioned, Adam, the ability to adapt to changing markets in the future to modify that business strategy around storage when the opportunities arise.
Yeah, understand. Thanks. Very helpful.
I have a question, if I may, coming from one of the research analysts from Stifel, from Ian, asking us around non-UK acquisitions in the pipeline and how would we intend to finance those. At present, we have significant financial capacity in existing debt facilities and to raise further debt facilities, but still remain in our debt to gross asset value limits. And so in the short order, you should expect us to be issuing new debt products or securing new debt products. And then, of course, at a certain point in time, when the debt capacity, again, within our investment limits run out, of course, we would then have to issue new share capital to fund that subsequent growth. Currently, we would expect that moment in time to be quite a distance away. In other words, we have a lot of capacity to raise further debt before hitting our limits.
Thank you. And we have another question from Adam Forsyth at Longspur. Adam, go ahead and unmute yourself.
A couple of just sort of wider industry questions. Firstly, are you seeing any impact from higher polysilicon prices coming through into EPC pricing? And then secondly, I just wonder how you see curtailment risk developing in the UK in particular. I mean, your outperformance suggests pretty minimal impact on you despite COVID and the impact on demand. But I wonder if you've seen any thoughts for the future and how that might develop, particularly as we get more renewables into the UK system.
I'll take those initially as well, Mike. So from a polysilicon perspective, yes, we have seen that impact EPC pricing. We believe, and all of our supply chain suggests to us that it's a relatively short-term spike brought about by a fundamental kind of supply chain issues at the polysilicon level. We're expecting, therefore, 2022 to normalise. Pricing might not achieve the same levels as it did through 2020 and early 21, but we certainly expect it to bring future construction back online in 2022 for the industry. And then beyond that, we expect to see kind of relative stability as additional production capacity in the module market comes online. And moving to the second part of the question, from a curtailment perspective, we're very selective in relation to the grid connection agreements that we have within the portfolio. So we really do bear minimal curtailment risk on a rolling basis. What we saw through COVID was the network operators on the grid side moving the periods in which they conducted some of their maintenance. So we did see a concentrated period in the second half of 2020 where more maintenance was conducted than normal, but as you see from the figures, that didn't have particular impact on our overall generation. And over the long term, we don't expect this portfolio to be impacted in a big way by curtailment going forward. Obviously, the nature of the assets and how they're distributed geographically across different sections of the distributed network benefits or creates an environment in which we don't risk significant curtailment on a large scale across the portfolio because of that diversification.
Got it. Thanks. That's very clear.
We have another written question. How do solar IRRs compare between the UK and international markets with greater solar hours? So what we are observing across international markets, and in particular those markets that could be of interest to NESF, so the more developed countries like the US, like Spain, like Portugal, like Italy that Ross discussed earlier, we are seeing opportunities there characterized by a number of different benefits. The first one certainly is higher IRRs, and those can be depending on the markets, maybe premia of up to even 200 or more basis points better than what we see subsidized assets trading in the UK for, in terms of levered equity returns. We see on those assets lower exposure to power prices, where the offtake agreements usually, not exclusively, but usually cover much higher percentages of the energy generated. And so we with very attractive debt financing products available to finance those assets. So as we look at those opportunities, we see significant benefits individually in each asset that we would consider for NESF. And then, of course, from a NESF portfolio perspective, it adds revenue diversification, market risk diversification. It reduces the percentage that is exposed to short and medium term power price market risk, and so on. So we see many benefits for NESF in looking at those international opportunities. As a reminder, as I said earlier in the presentation, we as a group have now investments in the solar sector in the US, in Chile, in Portugal, in Italy, in India, and in short order, we will be adding new geographies like Spain, Poland, etc., to the portfolio outside the UK. So as an investment manager, you have a group of solar experts that have extensive experience across the main solar markets. And of course, we bring that to bear when looking at international opportunities for NESF.
Thank you. And given the rising inflationary concerns, can you discuss how it impacts NESF vis-a-vis higher project costs, potentially higher discount rates, but higher cash flows?
So with moderately higher inflationary concerns or forecasts, we have a few of our outstanding contracts that are connected on the cost side to inflation. And so our exposure from a contractual operating expenditures perspective is quite limited. On the other hand, as you know, first of all, our ROC income is RPI linked. And so if inflation does increase, that has a beneficial impact on our ROC prices. On top of that, as I've showed you on the earlier slide on short-term and medium-term power prices in the UK, we have seen a significant inflationary effect on our revenues, i.e. significantly higher revenues than forecast. And so actually, as a group, we are more exposed to the upside from inflation, i.e. higher power prices, higher revenues, than we are exposed to the downside of higher inflation, i.e. exposure on the operating contracts in place.
Thank you. And we have another question from Marcus Jaff at Peel Hunt, who asks, can we get an estimated figure for the amount of debt capacity that NESF has, and what gearing level would this take total debt to?
So we have just under 40 million available from existing facilities and around 100 of additional capacity to take us just under that 50% debt to cap limit.
And we'll go to Charles Murphy from N+1.
Can you talk a bit about what's going on in the futures market and how come advisors' forecasts are so disconnected?
Sure. Ross, why don't you take a first stab at that, and then I'll add to that if I may?
Sure. It's a great question. So we obviously see advisors or have seen advisors throughout the COVID period reducing the power curves over the long term. As we've said, we are seeing this significant disconnect in the short and mid term to those curves at the moment, and we are expecting over the next few months to see some positive movement in those curves, which will be a positive change. Over the long term, look, we see an under forecast in the way in which we expect consumers to adopt things like EVs. And we also see a faster adoption of electrification of heat and more of a drive towards achieving those net zero goals by 2050, all having a positive impact on the curve. Clearly, there's a lot of volatility in the late 30s brought about by the amount of offshore wind that is being predicted to be connected. And we don't see all of that capacity necessarily being achievable based on current on-country infrastructure to cope with that incoming power. So I think, there are many reasons to be positive when you look over the short and mid-term of those curves relative to what the advisors are telling us. And we expect to see that kind of realise and work its way out of the process over the next 5 years.
Yeah, and if I may add to that, it's interesting to see how it's not just the very short-term power price that is disconnected to the advisor's long-term forecasts, because those short-term disconnects could be driven by short-term effects on gas prices or carbon pricing. What is interesting to me to see is how even over 2 years from now and 3 years from now, where any kind of short-term market dislocations, be they weather, gas price, carbon pricing, et cetera, connected, should actually have worked themselves out of the system, there is still that perspective of much higher prices in the UK versus what the market consultants are forecasting. So there is a significant disconnect between what people are trading power at and what these long-term forecasters are projecting. Those that have heard us speak many times will remember that we have consistently said that we expect that the higher probability outcome is for prices to be above those curves rather than below those curves. And I think that has borne out in what we're seeing over the next 3 years in the traded market. So do we see any reasons for which there should be a downward shock from those forward markets? No, we don't see any external events that will lead us to believe that suddenly those forward curves are vastly overpriced and should dramatically decline. Obviously, it is always possible, but from our perspective, we don't see any external drivers coming over the horizon that would lead to a significantly lower market price, which, as Ross said, should influence the way the consultants look at the long-term power price in the UK. I would add that there are observers that have been talking about power prices going to zero in the UK, and everything being a terrible long-term perspective and short-term perspective. None of that has come to bear, or even we're not seeing any signs of something like that happening. And so, we are very comfortable with our long position in UK power.
Thank you. And the next question's from Sam Banerjee from SureCap, who asks, congratulations on the higher target dividend. Given the higher power prices being achieved by NESF, do you have an estimate for what the dividend cover might be for the 21-22 year?
Yeah, thank you. Certainly it is good news that we, looking forward, have the confidence to increase the dividend again for the 7th or 8th year running since the IPO. Our own personal target for dividend cover is to have a higher dividend cover than what we've announced today for last year. Now, of course, there are a number of factors that will drive that, including asset performance, i.e. irradiation generation performance over the next months, and growth targets being met, energization of assets being achieved, and so on. But as I said, Sam, our objective is to increase the dividend cover for this financial year.
Thank you. And when you get to the point where you eventually raise funds via share placing or open offer, will you use primary bid to enable private and small investor holders such as myself to take part?
It is certainly our strategy to increase our following among retail shareholders. Our recent experience with primary bid, I can say, has been positive. And so certainly that will be something that we will propose to the board to use in raising further capital for the fund.
Thank you. And we'll go to Charles Murphy at N+1 Singer. Charles, go ahead and ask your question.
Earlier in the presentation, you're talking about higher power price volatility as part of the battery strategy. Do you see this as an intraday issue or more of a seasonal sort of volatility?
It's a bit of both. The intraday volatility will be where the batteries make the majority of their revenue, and it's clearly where the grid struggles the most with balancing power, given the increased penetration of renewables and the volatility of the weather. So yeah, intraday for the majority of the revenue stack in batteries. Seasonal, there will be increased volatility, but less so from less of interest for a battery storage perspective.
And we have a question again from Sam Banerjee from SureCap. Are you seeing any shifts in the industry in sourcing of solar modules away from those produced using labour from the Chinese province?
Xinjiang.
Yeah.
Ross?
Yeah, certainly. So this is a key area of focus for us, as you can imagine. We take any suggestion of human rights abuse in any area of our supply chain extremely critically, and we were one of the first movers in the industry to be deep diving with our manufacturers exactly what was going on within their supply chain. We've worked closely with industry bodies over the last 6 months or so to encourage the UK solar industry to adopt a pledge similar to that was adopted in the US to drive a better supply chain protocol and increased auditability and traceability throughout the supply chain. There's no quick fixes to this type of an issue. So what we're really engaging upon as an industry and as a business is long-term change, and we are being kind of instrumental in driving that process at industry level. But something as a business, we as I say, we take extremely critically important, and we will continue to make strides alongside industry peers to improve all aspects of that supply chain over time.
Thank you. And I'm afraid we've run out of time. Michael, do you have any closing remarks?
Thank you. Thank you for organizing. Thanks to all the attendees for attending our full year results presentation. Hopefully, we will be in contact with you, offering further meetings if you have any additional questions or comments. And again, thank you for your support and attendance this morning.